Hey, Renter Retires. It's Adam Schroeder here with another episode, and I am pleased to be joined today by Scott Brown. He's the partnership manager over at Steadily Insurance, a company that we recommend to our investors to definitely check out and get a quick quote on their property insurance. So thanks for joining us, Scott.
Thanks for having me on, Adam. I'm excited to talk super exciting insurance over here today.
It's what we get. People are always like, man, insurance. We need to have insurance on more. Every episode needs to touch on insurance. So tell us a little bit about, everybody knows you have to have home insurance. If you're getting a mortgage, you should have home insurance, even if you're getting, even if you're paying cash on a property. It seems like, just thinking about it, all home insurance is created equal. I'm assuming, based on the fact there are many insurance companies out there, that's not true. So can you tell us a little bit about kind of, are they all the same? What are we looking at there?
Man, that's quite a can of worms you got right there. So the long and the short of this would probably be there's lots of different types of insurance out there. There's some pretty obscure types of insurance that are pretty in the weeds types of coverages versus much more common. As you guys know, the two most common insurance are by far away home and auto. Those are going to be the basics. So there's a lot of traditional carriers, the State Farms, the Geicos that have been in those traditional fields for a while with home and auto, and then they've had some other bundling options. What we kind of specialize in here at Steadily is landlord insurance. So we're definitely more in the niche side of the business, focusing in an avenue and kind of staying in our lane with that so that we can grow as fast as possible and kind of to specialize in it and be able to write it really well. Adam, insurance is a really complicated item. And it's always hard to kind of explain to people because insurance, the entire, premise of it is that you're explaining something that hasn't happened or you can't really visualize. So it's definitely a pretty nuanced topic. Definitely something that you can always get educated on more. So a lot of the companies kind of vary as far as how they operate and whatnot. There's those traditional carriers and there's kind of us in this space. It's kind of a little bit of a twinger, has a carrier and everything. So, yeah.
So what's the difference between landlord insurance and homeowner insurance?
So the main difference here, Adam, that's a great question. Let me segue into this real fast. So it's really scary stat here. 10 to 20% of landlords have homeowners insurance today. So let me just start out with that. The main difference here between homeowners and landlords is going to be owner-occupied versus non-owner-occupied. I can go in a little bit more detail as far as kind of why there might be a price difference as far as like if you were to have your own home residence. Well, guys, let's just use an example of like $2,000 a year for homeowners insurance. On average, the landlord insurance is going to be about 10 to 20% more expensive. And that's because, again, going back to the owner-occupied versus non-owner-occupied, typically in non-owner-occupied properties, there's going to be more claims on average. Again, it's property specific, but given that there's non-owner-occupied households, it's going to be less likely. It's just the nature of how things work that if you owned your own house and there was a fire in the kitchen, you might be a little bit more likely to stick in there and try to get the fire extinguisher versus a renter might say, okay, the house is on fire. I'm going to get outside of the house. So just little nuanced differences like that. The main differences is again, landlord is going to be covering also general liability. If something were to happen at the house, if someone were to slip and fall, things that we don't like to think about. In addition, it's also going to be doing dwelling insurance. So if something, again, property burns down, something happens, a claim needs to be made on that. Whereas homeowners is really, you're going to be living in the property yourself.
So if I'm in that 10 to 20% of people who have homeowners and not landlord, does that mean if something comes up and you make a claim, they're going to deny you?
No. So a lot of these questions here are going to be in the weeds, and that's a great in the weeds question. So the best way that I can explain this, Adam, would be we would like to avoid those situations whenever possible. So I don't want to say...
Do they have the right to deny you if
yes,
you have...
Yes, they do have the right to deny you. So I don't want to say point blank that if you have a homeowner's insurance and you had, you needed to file a claim, I don't want to speak for that insurance carrier. I don't want to speak for them, but typically what will happen is more often than not, it'll go one of two avenues where either the claim actually will be accepted, and that's the best case scenario. But then the insurance carrier is not going to want to renew the policy for the following once it comes up for renewal. Or to your point, the really scary aspect of you guys, the claim, wasn't accepted because the property is not being used as how it was insured to be used. And so it keeps on coming back to making sure that you have proper type of insurance for your home.
So one of the things I know whenever I go through and do the quotes all the time, I think of things that I can cut out, things I need to keep in. And one of the things that always gets on the quote initially is, coverage for items inside the house. And so that's, they might say you want 10,000, 20,000, whatever. Is that something that you can cut out if you're requiring your tenants to get renter's insurance, or is that something that everybody should leave in there? Or what are your thoughts and Steadily's thoughts on how, on what you can do in that situation? Do you need it, or is it kind of a double dipping?
I would say everything is case by case. It again has to do with each property and each tenant and each landlord as far as how things are going to be going down. But if I personally were the landlord, I would err on the side of caution with having coverages rather than not. I would definitely advise on keeping coverages. So basically, the renter's insurance aspect, think of it as far as renter's insurance is great for them. So if you have tenants in the house and something were to happen to them, they are covered. Their property is covered. If something were to happen to, even let's say that you have a tenant in the house and they had a friend and something happened to the friend in the house, they broke their leg, it's going to be coming down to the insurance claims as far as the adjusters, as far as who was at fault and who's basically going to be paying for it, whether it would be the landlord insurance aspect or whether it would be the renter's insurance aspect. So again, going back to, if you only have one or the other, if it does fall in the bucket that the renter's insurance wouldn't be covering it, you guys would be at risk. So the very short way of saying I would err on the side of caution. But again, each person has their own risk tolerance, and each property and area and demographics and geography has decisions into factors into your decision making there.
Yeah, I was mostly talking about there's a coverage in there where you can cover the actual physical things inside the house. And if that would be the same or different than renter's insurance.
Yeah. So again, going back to that would be a lot more probably on a property specific situation there. And then also going back to we do both short-term and long-term rentals. If you're a short-term rental, that's definitely in more of the baseline coverages that we offer, that there is more coverages on property in basically the property that's inside of the house, because short-term rentals typically are a lot more furnished and have a lot more goods inside of the property. So that might be a little bit more nuanced there. What I would suggest is, again, not to try to push us too much, but our agents, they talk to real estate investors all day, every day. We're not upselling or bundling with home or auto. So if you guys have any questions about this specifically of additional costs on that stuff, talk to a Steadily agent. Again, they're very well versed in how to have that conversation, not only from an insurance perspective, but from a return on investment perspective. Is this worthwhile to add this coverage? If I were to drop this coverage level down or drop it entirely, how would this affect me from a risk portfolio or whatnot? We can definitely have these conversations.
Yeah. So we talked a little bit about when if they could deny your claim, pay your claim. There's a lot of companies out there, like you said, your State Farms, your Geicos, your Farmers, all of these ones that people have heard about. But then whenever you get landlord insurance, there's a lot of companies out there who you haven't heard about. So is there a good way to kind of figure out who's a legitimate insurance company versus somebody who's going to take your payment, and then anytime you have a claim, they're going to be like, no, we're not going to pay on that one. And then you have to go through a big rigorous process trying to get them to pay anything. Is there a way to vet insurance? Because I know Steadily does most of it, but sometimes you were saying there's some areas or some properties that you may not be able to. And so y'all go out and find people who can help. So how do we know that those people are actually going to pay whenever there's a claim?
Yeah, well, so with steadily partnered specific carriers, well, we make sure we have a vetting process that they're A rated or better through AmBest, and so that's kind of how we go through our process of making sure that they're going to be able to pay out their claims if a claim is filed. So again, AmBest is what I would suggest for the insurance as far as getting reviews, making sure that claims are processed and paid out in a normal fashion. But I always like to advertise that Steadily pays out 100% of the claims that is filed for correct reasons. Essentially, again, if you file a claim with Steadily for something that happens on your property, that's the point of insurance, and we're going to pay you out.
Okay. And one of the things that I think about whenever I'm filing claims, I know other people think about whenever they're filing claims, is how is this going to impact my renewal, my rates moving forward, or even whether the insurance carrier wants to renew with me. Can you talk about when does it make sense to even file a claim? Is it just if it's above your deductible? Is it if it's a certain percentage over your deductible? I know that's probably a little more, it depends on the situation, but what impact does filing a claim actually have on your future insurance?
Adam, you kind of already hit the nail on the head there. That the impact of whether or not to file a claim has gotten bigger and bigger year by year because less and less carriers are in more difficult states, as we should say, to insure. So this is becoming more and more of a bigger deal as far as working through and being able to kind of figure out what we're going to be able to work through on that. Could you kind of work through that question again for me?
Yeah. So, let's just say I've got a property, it's got a $5,000 deductible. I get a claim back. I have a damage that's going to cost me $6,000 to repair. If that's the case, I file a claim, they pay me the $1,000. Am I looking at an increase of, $300, $400, $500 a year in general? Or kind of how do I know, okay, this is going to be enough? If it's 40 grand, obviously that 35 grand, they're not going to jack your premium up that much. Kind of how much impact does filing a claim have on your renewal of the property?
Yeah, that is a really good question. So it is going to be a lot more property specific with that. I know that's not a super popular answer, but it's kind of the nature of it. And so one thing that I would definitely factor in, if you are in a more difficult state that has had carriers leaving more often, more as of recent, definitely looking into the factor of the cost of, if you do file a claim, that you are risking, that carrier might be a little bit less likely to want to renew on that property specifically moving forward. So I'm careful because I want to be tight-lipped on how I would handle it versus because everyone has different risk profiles and whatnot. But all I could advise is definitely factor in, if you are in a more difficult state, I would maybe advise on having a bit of a higher deductible to keep the premium on the lower side. But again, I can't advocate enough, to each their own, and everybody has their own risk profiles on that. That is an immensely property-specific, investor-specific type of question as far as kind of what their risk profile is between that. And probably the best way that could be answered, guys, is again, having that conversation with one of our licensed insurance agents, of being able to walk through of, hey, okay, if I were going to make a claim on this property, what would my future prospects be as far as the difficulty? Because it really is pretty location specific as far as how many carriers are in the market in here, and essentially what can we qualify with.
Yeah. So let's just say I'm in a state where there's plenty of insurance. It's not going to be an issue. Should I expect is there a percentage even? Like if I file a claim, I can think maybe 5, 10, 20% higher the next year? Or, how do you figure that out?
No, because again, it's tough for us to tell because it's all based off of the reinsurance at the end from a macro perspective. So for instance, obviously Florida's the tougher state right now. Florida's gone up in cost quite a bit. It's not going to be because of that one specific property then when they're renewing, it's going to be because the entire community as a whole has gotten more expensive because there was a hurricane that now wiped out X amount. They're needing to charge more premium to make up for the risk that's adjusted there. So it's a lot more on a macro scale as far as that's
okay. Yeah. So let's talk about the amount of coverage that someone needs. I know people have heard there's the replacement cost value, there's the actual cash value. Can you explain the difference between those a little bit? But then also, what as an investor are you required to get the replacement value? Can you get can you talk a little bit about those two things?
Yeah. So guys, as far as this, I'll start out with the last question. So if you're an investor and you're kind of working through, the easiest way is essentially start out with, are you working with a lender? And if you are working with a lender, ask them, do they have any lending requirements? That's number one, as far as the easiest way to work through on that. And then Adam, could you remind me the first two questions also?
Yeah. It was what the actual cash value versus replacement cash value is, and which of those two, which two lenders that you've seen mostly say that it is, and then kind of if you could talk a little bit about what they are and also when you might want one over the other.
Yeah. So actual cash value, guys, is going to be basically if something were to happen on that. Let's say a $200,000 house burned down. It would be basically what would they pay out for you on the value of that property at what it is today. So it basically includes depreciation in it. So any policies that include actual cash value are going to be significantly discounted compared to replacement cost value. The difference between actual cash value and replacement cost value is also that replacement cost value is if that $200K house burned down, how much would it cost to rebuild that same house today? And so that's a lot more for future based. So that's going to go into why replacement cost is going to be a lot more valuable for you to have on your coverage. But obviously with that value being in place, it's going to make your premium quite a bit more expensive as well. So kind of segueing that into the second question, as far as which ones make sense to use. Again, it's a lot is to each their own, and it's a risk profile and it's figuring out. But typically, on average, the best situations for that, it's a lot more appropriate for a lot lower market value homes to be actual cash value. It might make more sense that, hey, if you have a much older property, that if something were to, if that property were to burn down, that it would make more sense to get the actual cash value out of that house and rebuild new or do something else with the funds that you get from that, rather than paying a heavy premium to have the replacement cost value for this old property that, again, you might be better suited off to just start fresh or start with something else or whatever the case. So that's going to be the biggest one, is essentially if something were to happen to that property, you're going to get a lot more replacement through the replacement cost. Actual cost is going to be more just with depreciation included.
Okay. And with replacement cost value, is it tied to actually replacing the house? Are you obligated to replace the house if you have that, or can you take the replacement cost value, sell your lot, and go invest in other properties?
That would be a good question to confirm with an agent, but to my best knowledge, that's going to be where you would replace the cost with, or what you would be building the house back with that replacement cost. And Adam, what we're typically hearing out in the field, as far as what's pretty normal these days, as far as being on the cautious side, it's a good idea as far as a rule of thumb for per square foot for replacement cost value, you should be looking at probably $120 and up. So what a big thing I would highly advocate people to go through on their policies and review are making sure that's going to be up to par as far as that.
Yeah. And for that, people, you can just go on to your MLS or Zillow and see, search new construction, start dividing numbers and see how much the big boys are charging for their properties. And that'll give you the amount. Now let's dive into the dwelling coverage, because, you mentioned the actual cash value, the replacement cash value. Is this something where if I'm buying a new construction property, all I have to do is say, I'm buying this property for $300,000. Y'all are, let's say it comes back and they're saying, oh, well, your dwelling's $400,000. Can I just say, that's great, I don't want that, I'm paying $300,000, so give me $300,000 in coverage? Or does it have to be based on what the lender is telling you the cost per square foot is?
It's usually going to be what the lender is telling you.
Okay, well, that's no fun. Whenever they tell you more. So what are some things when people go through and get their insurance quote, what are some of the things they need to be on the lookout for? Like whenever, y'all are working with clients, what are some of the big things that you focus on that tell people, yeah, you should probably look into this more, or that one doesn't really make a difference? Because I know when I went on your site and I'm running some quotes, it said on it like, big impact on price, medium impact, and then like basically this isn't going to touch it. What are some of the big things that you've seen people kind of wrestle with, and some of the things that y'all recommend when it comes to getting their quote and what they actually need in it?
Biggest one, replacement cost. What we see, not through Steadily policies, but through existing policies that we might see around renewal or whatever. It's kind of scary as far as the replacement cost value. A lot of times people have it at $60, $90. Like, again, not enough to rebuild. And like, we can talk about that now, but again, someone who's experienced that and hasn't had enough replacement cost to, that's not a laughing matter. And so that would by far and away be the biggest thing that I would say is to review on your policy. Is your replacement cost going to be enough? Are you going to be able to rebuild your house if you have something happen? You want to be able to recoup on that investment and make sure, again, if something were to happen, it's there to use. High impact on pricing by far and away is deductible. You guys, again, we're really tailor built for those mom and pop landlord investors that again are toggling back and forth between coverage levels, deductible levels. But again, insurance has been a rising cost in the last few years. It's been getting more expensive. We want to give a little bit more control on the line item on that. The deductible is going to be a big opportunity there. So one thing that you guys will notice on our online quote tool, usually when we present our first price, it's going to have a $2,500 deductible. And that's basically assuming that if something happens on your property, you're going to be able to you're going to be able to file a claim and pay $2,500 out of pocket. And that's going to be a lot less than if you had a higher deductible. But again, everyone can factor in, when is the last time I personally have filed a claim on a property? Okay, am I okay with the risk of paying more this year for this upcoming year if I do need to file a claim? Again, lots of risk tolerances to go through. But if you guys are looking for a lowered premium, definitely as far as like high deductible would probably be the biggest factor there.
And talk about, you mentioned kind of, we've talked a little bit about kind of getting a quote, and I've mentioned what I've seen going through it. So tell people a little bit about how they actually use your platform, because talk through kind of using the platform.
Yeah. So the entire idea is it's supposed to be simple, easy, and convenient. So what we've done is we basically brought what a lot of the traditional carriers 15 to 20 years ago did was, Geico, State Farm, Farmers, they did a great job building out like an online quote tool where if you were looking for homeowners insurance, you could type in your home address. Basically, that's now what we've done for real estate investors or landlords. We want it to be able to where you can literally go on our website through rent to retirement referral link, of course, Adam. But you can go through, our website and obtain a quote basically in just a few minutes. So you type in property address, basic contact information, name, number, email, how many claims you filed in the last 5 years, home address, and birth date. You guys, that's about it. So it's a lot better than when you're talking to an independent broker and going back and forth and you're answering the 75 questions that you think they should have the answers to by now, but they just don't. So it can be a pretty repetitive process. Again, we preload all of the information on your property through third-party vendors. So basically, as soon as you submit, we're loading a quote. Depending on where you are in the country, if you're more coastal, it might be a little bit less streamlined. But the goal of it is that you can get an online quote from us in about 15 seconds from submitting. If you are on the more coastal, you might get kicked a message about basically working through the process, waiting for an agent to reach out to you. And then they'll basically gather the last additional details that they need to finalize quotes. But really from there, you'll get an online quote within minutes. What I would highly suggest is when you see that online quote, if you're surprised, just as a refresher, it's 10 to 20% on average, 10 to 20% more expensive for a landlord insurance policy than it is a homeowner. So that might be one factor. And then the other factor might be that we have a low deductible as our initial setting on our online quote tool. So definitely what I would highly advise is if you want to see how low your premium can be driven down to while having quality coverages, because that's what the insurance is there for, I would highly suggest talking to one of our insurance agents. Call that 888 number. They've already got your account information because you submitted the basic info. So we'll be able to work through super quick, get all the additional details you need, get a quote over to you, and figure out, what is your threshold for deductibles, certain coverage levels. Do you want additional coverages for water, waste, whatever the case might be, additional fair rental value? There's a lot of stuff that we are more than happy to work through with our real estate investor clients.
Okay. And just talk a little bit, you've mentioned Florida a couple times and insurance companies being leery of that state. What are the other states that have had some issues with, insurance companies wanting to get out of? Or can you name a couple of those?
Yeah. So guys, California, I'm sure it's no surprises. California with wildfires has been a struggle in the last couple of years. Texas, a little bit more on the coastal side, has definitely been a bit more of a challenge down in that area, and especially in the Galveston area and whatnot. And in Louisiana also. I would say those 4 states have definitely been a struggle, and a lot of people have been shopping their policies in those states. Let me just leave it at that. That's for sure.
All right. Well, we're going to put the link that you can go to get the rent-to-retirement treatment from Steadily in the show notes. Is there anything I haven't asked you about, y'all's platform or insurance in general that you want to wrap up with our people?
No, I don't think so, Adam. I think you asked a lot of great questions. I think this will be really helpful for a lot of your clients. And again, guys, I can't advocate enough. Rent-to-Retirement has been a fantastic partner for Steadily. We highly value our relationship with them. This has been fantastic. And again, can't advocate enough. If you guys have any questions about landlord insurance, or again, any types of real estate investor insurance, I would I'll leave it with that. I would highly advocate pick up the phone and talk to one of our insurance agents after you submitted through the referral link for rent-to-retirement, of course. But again, it's not going to be a salesy environment where they're pushing you in any fashion. Basically, you're going to be you're going to be talking to an expert that literally only deals with real estate investors. We're not doing home and auto, and then it's a little drop in the bucket for real estate investors or landlord insurance. All we do is nerd out to landlord insurance all day, every day, 365. So we eat, sleep, and dream about it. So I know that sounds pretty boring, but we're boring people over here, and we love doing boring insurance. So it's a good little fit. And we're more than happy to work through any of your nuanced investing questions as well. So that's the cool thing, is that we think of it as an investment, not just insurance option as well.
All right. Well, I really appreciate you taking the time to come join us today. Again, though, the link will be in the show notes. You can also head on over to rent-to-retirement.com and see what properties you might want to acquire that'll need insurance. So that's at rent-to-retirement.com. As usual, if you have any questions that you want answered in future episodes, email them to podcast@rent-to-retirement.com. That's podcast@rent-to-retirement.com. Really appreciate the time you spent educating yourselves today. We'll talk to you on the next episode.
Thanks for watching the Rent to Retirement YouTube channel. Check out some of our other videos, like this one, or this one here.